You're listening to the Moose on the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today on this beautiful Tuesday. Tomorrow is tariff day. There's a lot of uncertainties on the market. So today we're going to talk about how you can craft an investment thesis so that you can invest with conviction. So what's the point of having an investment thesis? Well, the thesis is the story you tell yourself. It's the, in the financial jargon, is the qualitative analysis. So in words, how a company is a good investment or a good fit for your portfolio. So how can you do that? Because it's not that easy, of course. And I want to offer you a framework today so you can have like a better idea of how you can craft your investment thesis, invest with conviction, and not having to care too much about what's going to happen on tomorrow or the day after, because we know that there will be a lot of noise about that. So there are like two parts of the investment thesis that I like to craft. So the first part is about the business model. The business model, and also in other words, what makes that company unique and great, and that will continue to generate profit down the line? Because that's the whole idea, right? You invest, you want to pick a great company that will continue to thrive, because if it thrives, well, it's going to make money. If it makes money, well, chances are more dividend, more capital gains, and a happier investor, right? So the first thing is to narrow down what's the business model. So the business model is really to understand how the company operates. A good way to do it is to narrow it down to its playbook. So literally, what's the company's playbook? And the goal here is to be able to explain that to a 12-year-old. So if you can put that into simple words that anyone can understand, that means that you do really understand what's the playbook of that business, how it's going to run its operation, and then you fall into growth vectors. So first the playbook, then the growth vector. So how this company is able to grow in the future. Does it grow by acquisition? Does it grow by having more demand for its product, by investing massively in research and development? So in innovation and offering new services, new products, doing like cross-sellings. There are plenty of ways to grow the business, but how the revenue is intended to be to grow in the future. So you need to highlight the growth vectors. And finally, you have to define the economic moat. So what makes that company so unique, or the competitive advantages, if you prefer. So maybe it has like an amazing network because it has like patents, so you cannot replicate what they're doing. Maybe the barrier to entry is like super high. Maybe the company is operating in an oligopoly. There are like plenty of economic moats as well. So for the first part is all about the positive things that you have to say about the business. So understanding the business model, understanding the playbook, the growth vectors, and the economic moat. And then, of course, unfortunately, nothing is perfect. So on the other side, you also have to assess risks. So what could go wrong for that business? Because it's all fun to think that it's all rainbows and unicorns and the company that you buy is going to skyrocket. Unfortunately, there are threats. So you have to identify them. They are kind of like three types of threats that you can define. The first one is business vulnerabilities or flaws. So what could go wrong for the business, how it works? So if it grows by acquisition, for example, well, there's always an integration strategy risk here. So maybe you're making the wrong acquisition, maybe you're paying the wrong price, or you could also go into debt. So those are part of like the business model flaws that could hurt the business down the line. The second type of risk, well, industry and market threats. So if something that is outside of the business control, could be regulation, could be competitors, could be what's happening in another country. So it could be like all the things that they do not really have a real control over that. Thinking of like Franco-Nevada, for example, and the Cobre Panama mine that has been closed for like more than a year now. Little control over that. They can negotiate with the government, but the government says no right now so far. So it's pretty hard for the business to find ways to make money out of the Cobre Panamine as long as it's closed, right? And finally, competitive landscape. So identifying who are the competitors, and also if there are maybe another better option to invest your money in. For example, Canadian banks, you have like 6 big banks, and then you have like smaller players like such as like Propels, EQ Bank, Go Easy. So looking at the competitive landscape will give you on one side an idea of like, okay, so maybe this company is going to have a hard time growing its business because there are a lot of competition, and also maybe I'm not selecting the right bank, and I could take another one that has like stronger metrics or a stronger narrative, and then I should go for this one. So it kind of like gives you a choice of selecting another business on top of that. So to give you an idea quickly, and before we go to the idea, if you do not want to miss any of those Moose on the Loose and any other of my other free content, subscribe to my newsletter, because every Friday I do a wrap up and I tell you everything that I wrote, everything that I've recorded on the podcast, on YouTube, so you can get and pick exactly what you want. So you can go to moosemarkets.com/newsletter. So that's moosemarkets.com/newsletter. Register there, and you're going to have like a weekly newsletter telling you everything that I publish for free. Now, let's do a quick investment thesis. So of course, like not in details because we're running out of time, but just to give you an idea of how you can apply that. So I decided to do that with Enbridge, very popular company among investors, high yield, been able to increase its dividend for a long time. So that could make a good way. So business model. Well, Enbridge, one of the largest energy infrastructure in North America. So they are transporting oil and natural gas. So oil and gas pipeline, about 50-50 for the revenue, and they have long-term contracts. So that's the business model. Their playbook, super simple. They charge a fee to transport the liquids. So it's a take or pay contract. So whether or not the company is using the pipeline to transport oil or to transport natural gas, they have to pay a minimum fee. And then if they actually use it, well, then they pay the full price. So it's really like a toll road. It's a cash making machine. See how simple I narrowed down? Of course, it's a lot more complicated, but just to someone understand that, you know what? Well, we have oil at one point of the country. We have to transport it somewhere else. Well, we need a pipeline. They charge a fee to transport the oil, to transport natural gas. Growth vectors, of course, demand. As the economy is growing, like higher demand for energy and then for oil and gas. They can also do optimization of their pipelines, minimize their costs, optimizing the transportation, so being able to generate more fees out of that. And of course, they can build new ones. Economic moat, well, very high barrier to entry, because I mean, like a toll road, like a railway, like a bridge, once you have a pipeline built, first it costs a lot to buy another one, to build another one. And once it exists, well, technically you kind of have like the monopoly on that pipeline, and it's going to be very hard to build a new one. It's going to be hard also because regulations are heavy. So that works both ways. We'll see that in the risk, but still very tough regulation also means that like new projects will be hard to make. So once you have one that is accepted and rolling, well, there you go. You're a little bit safer. Finally, sticky contracts. So very sticky business. Most of their clients cannot really go shop elsewhere. They have like super long-term contract. We're talking about like 20, 25 years sometimes. So very hard that the other companies needing oil and gas transportation will change suppliers of pipelines. Not that many, so that's great. On the risk side, though, because of course nothing is perfect. Business flaws. First one, growth by acquisition means there's an integration risk, as I said, and also costs. So it costs a lot. It's capital intensive. The company is increasing its debt a lot, like over and over and over. So interest charges are increasing as well. That has an impact on their cash flow, because a lot of that cash flow needs to go back to pay off that debt. And over the past 10 years, the debt is just growing all the time. So that could end up into a bad story one day. Industry and market threats, well, of course, regulation, probably figured that out. Potentially having spills, legal battle. Enbridge went through a lot of legal battle in the past. past. Higher cost of operation because of the higher regulation, taxes, not super environmental friendly. So that could also put some brakes into new projects. Maybe the tariffs down the road, because if there are like heavy tariffs on oil and gas, maybe that Enbridge will suffer from this, like lower demand to transportation. So that could be another problem. Finally, competitive landscape. Well, there are a lot of competitors, but as I said, like it's very, very solid economic mode. So it's more like other options. So you could look at investing in Pembina or TC Energy, for example, or Kinder Morgan, Southbow, Enterprise Product Partners. You have like a lot of other options that operate in the pipeline business on both Canadian and US side. So that could open the doors to a little bit more research to see which is the best one. So again, Moose, that's enough for today. If you don't want to miss any piece of my content, register to moosemarkets.com/newsletter. Every Friday, you're going to have like a wrap up of everything that I've published overall this week. And tomorrow, well, we have a special show on Tariff Day, or Liberation Day, as President Trump is calling it. So we're going to talk about what you can do with your portfolio at this very precise time. All right, Moose, take good care. Tomorrow we're going to talk again. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.